Let's get started with our first speaker. He is going to talk to us about the investment climate in Latin America, the opportunities, the risks. He's the Chief Investment Officer and founder of INCA Investments, a Latin American investment management firm based in Miami. INCA has more than $400 million in assets under management. And before founding INCA in 2005, he was with Zephyr Management, where he was sole portfolio manager of the Zephyr Latin America Fund. Today, he continues to manage the investment strategy of the Zephyr Latin America Fund via INCA's sub-advisory role. He's a native of Peru, has lived in South America, Mexico, and the Caribbean, and we are honored that he's come to speak with us today. Please welcome Fernando Donayre.
Thank you. Can you hear me okay with this microphone? Well, I want to just make two quick points before I get started with the presentation. One, I have to apologize up front. Somehow in this chilly Miami weather, I've managed to catch a cold, so excuse the intermittent coughing. Secondarily, I just want to tell you just a little bit more about INCA Investments and what we do so that you can put our presentation in context. As John mentioned, we manage assets for clients, not Latin American clients, but actually international clients in Europe and in the U.S. through the major financial cities predominantly. And we invest in the Latin American stock markets. Now, when I first founded INCA, I was actually located in Mexico City. As John mentioned, I'm Peruvian, I'm not Mexican, but I'd just been stationed there by my previous employer. And after being there about a year and trying to make INCA Investments work, I realized that really there was a better place to do this from, and I thought of Miami. And unlike LeBron, who came to Miami because of South Beach, I came to Miami because I really do believe that it is the hub of Latin America. I believe it's the business center of Latin America. If you want to run investments across all of Latin America, I thought Miami was the place you needed to be. I was also on the show a couple of weeks ago where Dave Berry was speaking, and as you, the locals will know who he is. He's really a very funny gentleman. I like the way he puts Miami in context. He said, in 1986, I moved to Miami from the United States of America. And that just kind of buffets why it is that we have decided to be and are very happy to be here in Miami. So to get the presentation going, I'd like to just give you a little bit of background about Latin America and the stock markets in Latin America. And what we have here is the investable universe, according to Morgan Stanley Capital International, which, as you know, constructs the majority indices that are followed in the investment world. And over on the countryside, what I'd like you to notice is that Brazil makes 2/3 of our index. So 2/3, 67% of our investable opportunities are in Brazil. So Brazil largely is the country that really drives the Latin American investment environment. Second largest is Mexico. You can see how far down that goes down to about under 20%. Next one's about Chile at about 7%, and then you have two more countries which only make up about 3%. So again, one of the key things to think about there is that when you look at least at the index, the driver is Brazil. Now, the sector weightings, and that's also equally important, and I'd like you to focus on the two on the right there, which are materials and energy. Those two combined account for about 41% of the index. And those two are what we call the commodity sectors. There's a few other commodity companies scattered throughout the sector because of the Morgan Stanley categorization, mainly in the industrials. But all in all, if you total all the commodity companies in Latin America, they would account for about 50%, a little bit less than that of the Latin American index. So again, so what's important, or at least the main drivers, country-wise Brazil, sector-wise, it's commodities. Yes?
What year was that on the left?
I'm sorry?
What year is that on the left?
On the left, that says December 31, 2000, and should say 10. It may say 11, so I think someone got a little bit ahead of themselves when they were putting it together. But it's the most current ones. Okay? So now a little bit about what's been going on with the index and the performance about Latin America. And I'd like to point out a couple of things. And this starts out in 2007. Why in 2007? We were starting to feel what was going on, or that this crisis was maybe going to come and affect us. And because of that, you see that S&P 500 and the IPA index is starting to already go down. But Latin America isn't going down. Why would that be? Well, the reason is commodities. And that is that you may recall that part of the beginning of the decline was because the commodity prices were going up so high. That's when oil got up to something like 130, 140, I don't know, some astronomical figure. And that was concerning. That was slowing down growth around the world. And so the commodities continue to drive Latin America up until about the middle of 2008, when people realized, well, you know what? If the whole world goes really in a very negative territory, in a very negative global growth environment, then even commodities are going to be affected. And it's when commodity prices begin to go down and those stock markets, those stocks collapse, that Latin America finally plummets, and it plummets steeply. If you look at that peak to trough decline, you're talking about a 67% decline there over a period of 5 months. I've been doing this since 1990, and I can tell you I've never seen the Latin American index, which is the most volatile index, regional index in the world, I've never seen it go down that much, that quickly. That was a free fall, and you can see how much goes down, and then it waffles there for a matter of months. And then, though, something equally surprising happens. That's in 2009, around March or so, the Latin American markets start coming back very strong. And you can see that what has happened, Latin America has come back very strong. That 2009 performance, that's 100% for a region. That's unheard of. The next year, 2010, usually after 100% return for an index for a region, you have some sort of decline. But we didn't in Latin America last year. We went up about another 15%. Now, we've gone down a bit, about 4% as we speak right now for this year. But nevertheless, it's a very good bounce back from a very severe fall. Why is that? Well, part of it is the growth rate. I apologize that those numbers are a little bit slow, but we'll focus really on the ones on the right, on the average. And that is, if you look at the average numbers, basically, and I have the developed economies on top and then the Latin American economies down below those, you'll see that the growth has been better in Latin America than for the last few years and expected for the next 2 years. And there's one exception. If you look at Mexico in 2009, you'll see that Mexico went down tremendously, 6.5%. That's a huge fall for any economy. Why? Mainly was because Mexico was doing things wrong? We don't think so. Actually, we think Mexico was managing their economy pretty well. We think what drove it was due to the fact that it had such a strong correlation. Over 90% of its exports go to the U.S. And the U.S. people knew was going to suffer. And in particular, a lot of these Mexican exports are tied into what industry? The auto industry. And you know what happens to the auto industry. The U.S. auto industry gets decimated. So that affects the export side of Mexico tremendously. So, but if you look again in 2009, what you'll see is that, yes, there were declines, but the declines in Latin America weren't as severe as those in the developed world. And that was surprising to people because traditionally when the developed world goes down, Latin America goes down in a multiple. But that didn't happen this time. And why is that? Because Latin America had learned its lessons from its crises. We've been through crises in the 1980s and the 1990s. And one good thing about crises is that you put them to use and you actually get your house in order, you come back better than you were before. And that's one of my concerns about the U.S. I don't want to get into the U.S., but I sometimes wonder if we're not making the most of the crisis. But by and large, Latin America did, with one exception, Argentina. And they're not included there anymore, and I'll tell you why. Because Argentina is not even in emerging markets anymore. It's now a frontier market. This is an economy that in the early 1900s was the 6th largest economy in the world. Now they're a frontier market 100 years later. So this is what happens when you don't make some pragmatic changes to your economy after a crisis. But nevertheless, the point here is that GDP growth in Latin America has been better than developed world, and it's expected to do better. Why? Because they were pragmatic in their management for the last few years of their economies, and I'll show you some numbers that will support that. But once more, I want to talk a little bit more about the commodity side of the equation, and that is, as I mentioned to you, here we have it broken down per country. And you can see, so Brazil, 44.4% of its market is in the commodity side. And if you look at those two countries on the right, two companies, Petrobras and Vale, they make up, by themselves, they make up something like, I get 50%, 60%. Let me get that right. Okay, 40% of the Brazilian market. Now, the Brazilian market makes up 2/3 of the Latin American market. So those two companies make about 25% of the entire regional index. And that's unheard of. If you think of the S&P 500, biggest company makes up maybe 3% of the S&P 500. So here, two commodity stocks are really huge drivers for this index. So again, the commodity portion is so important in Latin America. And what is interesting about commodities is they're not driven by Latin America. Sure, they're the suppliers, and supply does have an effect on the price, but who really drives the prices of commodities? It doesn't happen in Latin America. Who's doing it now? It's China. It's a factor that's outside of the Latin American realm. Now, Latin America, though, what is surprising a lot of people is we're actually not an export-oriented part of the world. And some countries less than others. But if you see those countries in the green, those are Latin American countries compared to some of those Asian, East European countries, you'll find that we actually export very little. If you look at Brazil, it's very surprising to people that Brazil only exports are equal to about 12% of its entire country's GDP. That's a very low amount. Now, a lot of those exports are commodities. In many cases, some of these countries, it's 75% plus of their exports are commodities. So, but nevertheless, if it's not really the export commodities that are driving these economies, then what is it? And we would argue it's consumption. Consumption to us is the most important part of what drives Latin American economies. Doesn't mean commodities are not important. It just means we believe consumption, and we believe the figures support what I'm saying is that consumption is really going to be the important driver to Latin America, has to be the important driver to Latin American growth. And so what's been going on the consumption side? Well, remember I spoke about the crises and they started managing their economy better? Well, what that resulted is taming inflation. Remember that 15 years ago, Brazil was basically still had hyperinflation. And these other countries have gone through various bouts with inflation, but they start really managing their inflation. How do you do that? You manage your fiscal side of the equation, and you don't get into too much debt. And that's what Latin American countries they start getting pragmatic. And as they do that, they bring down inflation, and inflation is a killer to consumption. On top of that, when you bring down inflation, what happens? Your interest rates go down. The reason the Brazilian interest rate has gone down is because they still have a little bit to prove that they can continue to bring down that fiscal deficit that they have. And they're a little bit newer to the game, actually, than some of these other countries. But should they continue on this path, you'll continue to see those real rates go down in the long term. The point is now that you have low inflation, gives people stability, they can manage their resources well, and then they have low interest rates. And when they have low interest rates, what does that mean they can do? They can borrow. And when they can borrow some money to buy a microwave or a refrigerator or a car, all of a sudden consumption goes up. And then when they can buy a home, it goes up tremendously. It has a huge multiplier effect. So that's a little bit of a worry, I know, because now I'm talking about debt. I'm talking about increasing debt. But if you look at Latin America, we actually have a pretty low amount of debt. The government has lowest amount of debt now compared to the developed world, which has been a complete reversal. But the private sector, which is households and corporations, actually have fairly low debt. So the three countries there you see on the right, those are the debt levels. So those are pretty low. And so we are not tapped out the way the developed world is tapped out when it comes to corporate debt, when it comes to consumer debt. Now, I will tell you that there's one part of the equation that's starting to worry us a little bit about, and that is Brazil. Even though debt is low, it's largely because their corporations are relatively have very low debt loads. But what's amazing is that now the Brazilian consumer actually pays a higher percentage of their household income on debt servicing than the American consumer. How can this be? When they actually have less debt, it's because they pay very high interest rates. So if you want to get a car in Brazil, you better be prepared to pay 30% plus in interest rates. So, but they don't look at it the way we do. They don't look and say, hey, this is a ridiculous interest rate. What they do is they say, hey, I need a car. If I can afford the monthly payment and it's going to get me to my job, or it's going to give me a sense of convenience that I've never experienced before in my life, if I can afford that monthly payment, I really am not paying attention to the interest rate. And that's how they get around those high interest rates. But we're starting to get concerned that perhaps household debt in Brazil, consumption debt, is a little bit too high.